Hey, welcome back. In today's episode, I'm going to go through the topic of crypto loans. What are they? What value do they provide? Now, how is it different from a bank loan that you and I are familiar with in TradeFi? But before I actually go through that, I'm going to go through what are the typical terminologies that you need to first understand before you actually take the decision or take that next step forward to actually take out a crypto loan. So I'm going through an example of a crypto loan provider platform, let's say Binance, but you have many other different types of centralized crypto exchange platforms that provide a similar sort of service. So let's use the example of Binance because it's one of the most widely known crypto loan platforms or crypto exchange platforms out there in the marketplace. So there is this notion of loan to value, which if we like to relate back into the brick and mortar into TradeFi. So if you think of the process that we currently do when we walk into a bank and we approach them to take out a loan, well, usually there is a process of putting a collateral, a securitized collateral that the banks can hold as custody before you actually go through the process of getting hold of a loan based on the deposited collateral. It could be your house when you take out a loan, or it could be some other hard assets. But the notion of first depositing a collateral in order to take out a loan is a well understood process that we currently do when we take out particularly a huge loan, right? They will always come to you with the requirement to deposit a collateral. So the loan to value in this case is the amount of collateral value that you're willing to deposit in order to take out the loan. Usually it hovers around 75 to 80% loan to value. Let's take the example. Let's say deposit $1,000 worth of property value as collateral in the bank. So the loan to value there is what is the amount, the maximum amount that we can take out as loan as a result of depositing $1,000 worth of property is $750. So in effect, what we mean by 75% loan to value, LTV, which is what is mentioned here, you're going to be at most can take out $750 of loan based on your $1,000 worth of property deposited value at the bank. This is what it's meant by loan to value. And the crypto providers out there, it's important to know that they operate under this over collateralized lending principle because they're in effect, they're not banks. The majority, if not all, of the crypto lending platform providers, they require lenders, i.e. the people that have securitized their assets under these centralized crypto exchanges, within which they can earn an annualized interest. But there's the other side of the fence, borrowers. So these are the people that are going to be taking out a loan based on those deposited collateral by the lenders. So it's very important to understand lenders, so the people actually deposit their collateral so they can earn, let's say, a 10% annualized interest rate. And then the borrowers, which is the customers of these crypto exchange platforms, they want to take out a loan, well, they can do so. But they have 75%, 80% loan to value at their disposal within which to take out a loan, but no more than that. And why is that? Is because we all know that crypto assets is highly volatile. They can go up and down in value. And the reason why they usually have 75 to 80% LTV is because it's just to accommodate particularly the actual volatility of the underlying collateralized asset. If it were to go down, well, they provide that kind of cushion. And that's the reason why, all right? Because like I said, they're not bank operators. They're not lending banks in the traditional sense under this fractional reserve lending. No, it's purely a market maker platform. It's supply demand where they engage depositors of their assets, collateral assets, and then borrowers to actually take out a loan based on those deposited collateral crypto assets. Okay, so it's very important that you have that understood, and that is what current LTV is meant for. Usually in this example in Binance, they you deposit collateral before you take out a loan, and usually the assets that you can take out a loan are usually stablecoins. In this case, it's shown USDT, which is Tether. So if I were to say I wanted to deposit $1,000 worth of BNB, which is the Binance native token, you can take a maximum of 750 USDT tether as a maximum because of this 75% loan to value, as I explained earlier on. And what is the initial LTV? You can treat it in effect as an email alert notification. So let's say, because of the volatility of the underlying collateral asset, let's say it's gone down in value, which means that the loan to value is not going to be 75% anymore. In reality, it's going to be 85%. So it's increasingly becoming undervalued for whatever reason, supply demand. This is no different from any capital markets out there in terms of pricing. In this example, if it's 85% initial LTV, that means that underlying crypto asset as a collateral has gone down in value and is rapidly becoming in a position of liquidation. But in order to prevent that from happening, usually they offer a buffer. Let's say if it approaches 85%, so we are in effect very close to liquidation, they send an email notification to the depositor of that collateral saying, hey, you need to actually add a little bit more of the underlying token in order to service the loan. So that is what this initial LTV value is. And usually it could be 85%, even though it's not shown here, but it usually hovers around 85%. And then the margin call here, it means, well, this is actually now in effect close to liquidation. And usually it's in the 90s, 95, perhaps even up to 100% loan to value. So this is the point where it actually becomes, in this case, Binance would actually liquidate the underlying crypto collateral in order to service the loan because it's really lost in value. And it's like a safety net mechanism more than anything else, right? This is standard practice that we are seeing in most of the centralized crypto loan providers, platforms out there. So that's pretty much, the typical fields, if you like, that you usually see. And then on the side of the lender, so the person or the people that actually have deposited their crypto collateral to be used as loans on the platform to Binance customers, they usually see what are the annualized interest rate as a result of depositing, let's say, a handful of Binance tokens on their platform as collateral, right? You have that information. I'll show you that next. In fact, I'll do that now. So what are the interest rates for borrowing, let's say, crypto, but mostly stablecoin assets in Binance platform? Well, you have it here. And this is actually the variable rate interest that you have. And this actually changes continuously under the supply-demand dynamic. As I said earlier on, is no different from how the capital markets function. The same principle, supply and demand principle, also applies in the case of taking out loans and depositing your crypto tokens as collateral before you take out the loan. And this changes continuously. So you need to actually understand how, what is the current rate, interest rate, the APY, the annualized interest rate is at the moment of, let's say, you want to take out a loan from Binance. I would always encourage you to actually find out what is the interest rate. This is like a variable rate mechanism that they provide. But equally, there is a fixed rate loan. So let's take the example of, I want to borrow Tether, USDT, for the next 30 days. And the minimum I'm willing to borrow is 100,000 Tether, which is in fact 100,000 US dollars, because there's this 1-to-1 ratio between fiat-backed stablecoin with the underlying US dollar currency is always going to be that 1-to-1 ratio. So in effect, when you see 100,000 Tether, it means 100,000 US dollars that you're borrowing. Okay, and the borrowable amount is 100,000, and this is the term and conditions. So for the people that want to take out USDT Tether, they need to put in a minimum $100,000 or USDT as collateral before they can take out the loan. At the end of the 30-day loan period, they'll 4.4 APY, which is a fixed interest rate. So these are the two types of loans. You have variable rate loan, which is shown here, and you have fixed rate loans shown here. And this is the same in any other centralized crypto borrowing platforms. They pretty much show the same sort of thing, right? And those are the two types of crypto loans you can take out from these providers. So really interesting there. And I'm going to show you another useful resource, which is called defilama.com. CEX transparency. So these are the list of those centralized crypto lending providers. So I've just shown you Binance. This is the largest out of all of the centralized crypto exchange platforms out there. This is a huge lender. They have 170 billion of assets under management. So this is the amount of collateral, crypto collateral that they have under their management. And then you have a whole raft of other competing centralized exchange platforms that provide the same sort of crypto lending services to its customers. You might have heard of Robinhood. Crypto.com is another classic one. So Binance by far is the leader in the centralized crypto exchange space, where it provides crypto loans to customers. But of course, with many other securities out there, they are counterparty risks. Things can potentially go wrong. They can actually file for Chapter 11, bankruptcy, if in US legislation speak. They could be fall foul of fraud, and we've seen, unfortunately, many incidences of fraudulent practices. You might have heard of FTX. So you've got to really do that research. One of my key recommendations would be to ensure that these crypto lending platform providers are a registered security, i.e. they are licensed to operate these platforms and these lending services in the jurisdiction that you live. Usually you need to resort to your local financial regulator to ensure that Binance is a registered security licensed operator in the country that you live. That would be my first usual due diligence that I would take. So that's one of the due diligence that I always advocate people to do, and that's just one out of many that you need to do. And this is again no different from how we shop around and take out fiat loans in the brick and mortar space in TradeFi. When we walk into the bank branch, we usually have to do a lot of paperwork, a lot of due diligence. Well, this is the same thing that we do in the crypto loan space. This is no different. So that is centralized exchange platforms, and Binance is the leader. Now, if we go into the world of DeFi, decentralized finance, they provide the same sort of services. I'm going to show you a huge list, and is actually growing by the day. What are the top leaders in providing crypto loans, but under a blockchain, which is what DeFi is. So Aave, at this moment in time, is the leader DeFi lending, crypto lending platform that currently has almost 29 billion worth of TVL, total value locked, i.e. this is the amount of crypto assets, collateralized assets, actually within the Aave lending blockchain platform. And they provide the same sort of services. It's exactly the same approach in Binance. The only difference is Binance is a type of centralized crypto exchange platform, not under a blockchain, whereas with DeFi, it's a blockchain lending platform governed by smart contracts. So there's a heap of other risks that you need to take into consideration. Smart contract risks, right? There could be loopholes in those smart contracts that actually govern these crypto loan services to customers in the blockchain. There could be rug pulls, there could be every other type of fraudulent malpractices in the smart contract level, even in the blockchain itself. So again, you need to do the research. You need to ensure that the smart contracts, this is what I would do, the smart contracts offered by these DeFi crypto loan providers have been audited by a third party, a reputable third party auditing firm like the Big Four or any other highly specialized boutiques, right, that is regulated by the public accounting body. So there's other ways where you can do those checks and balances research, but again, this is highly specialized in the sense that this is done under DeFi and requires additional due diligence that you need to check. Smart contracts risks, rug pull risks, malpractices risks governing the blockchains and so on. So you need to just appreciate there are different sets of risks. So both the CEX and the DEXs, which are these DeFi platform providers that provide and manage these crypto loans to customers, there are counterparty risks none the same. All right, so that is an important message that I need to leave with you. So that is all I'd like to discuss with you today. If you found it interesting, please hit the like button. Just share the video to your friends and colleagues at work. And if you haven't done so already, to please subscribe to my channel, as I regularly publish some interesting videos such as these. Anything to do with Bitcoin, blockchain technology, and the future of finance. So till next time.